Welcome to a deep dive into an earnings call that, well, the market treated like an absolute mic drop. We are peeling back the layers on RF Industries, that's RFIL, and their Q4 fiscal 2025 results.
Yeah, this really wasn't just another number.
No, this is the moment of, definitive proof.
Exactly. When you see a stock react the way this one did, up over 22% almost immediately, it signals that management didn't just meet expectations, they completely shattered the old narrative.
Right.
This quarter proves that their multi-year strategic transformation, that whole shift from being a simple component seller to a real solutions provider, is officially paying off. Big time.
Okay, so let's unpack this entire model validation. Our mission today is to figure out precisely how they engineered this breakout quarter, what specific pivots drove that profitability, and I guess the big question, are these results durable moving forward?
Well, the central story here is that their components to solutions playbook is finally delivering where it matters most, and that's on the gross margin level.
Let's start with those headline numbers, because they were truly extraordinary. Walk us through the bottom line, $0.20, non-GAAP EPS. How did that stack up?
I mean, that is just a spectacular beat. Consensus estimates were only hovering around, 8 cents a share?
8 cents.
So they delivered a profit that was 150% higher than expected. When a company triples the street's guess, you know something fundamental has changed in their business.
And the quality of that beat was backed up by a phenomenal top line. Revenue came in at $22.7 million.
Which comfortably crushed the consensus of around 19.75 million. So that's a nearly 15% beat and 23% growth year over year.
But here's where the real breakthrough is hiding, the margin story.
The gross margin hit 37%. And you really can't overstate the importance of that number.
37%.
That's an expansion of about 600 basis points year over year. They had set this near-term internal target of 30%, and they just blew right past it. It signals a seismic shift in their product mix.
And when you combine that strong sales growth with that kind of margin expansion, you just get explosive profitability.
Which is exactly what happened. It resulted in adjusted EBITDA of $2.6 million, or 11.5% of sales. Their own goal was to get over 10%. And they just sailed right over that hurdle.
So in context, what does this tell us about the new RF Industries?
It confirms that fiscal year 2025 was the breakout year they've been promising. We now have proof that they can operate on a much higher plane of profitability. They've gone from, a low-margin parts business to one that can generate double-digit EBITDA margins.
Diving deeper into the financial mechanics, management pointed right at operating leverage as the key driver. They're controlling fixed costs while sales are just taking off.
This is the classic efficiency curve finally working for them.
Yeah.
Management was pretty clear about it, noting that once their quarterly sales start getting above that $19 to $20 million threshold, profitability just increases dramatically.
So they essentially flipped a switch. They went from just covering overhead, rent, labor, all that, to generating almost pure profit above that magic number.
Precisely. They absorb all that fixed overhead at the $19, $20 million mark. So every dollar in sales above that level, thanks to this better product mix, falls straight to the bottom line with very little associated cost. Q4 at $22.7 million just proved the huge potential of that model.
And if you zoom out to the full fiscal year, the transformation looks even clearer. Full year net sales hit $80.6 million, up 24%. But the change in profitability, it's just dramatic.
It's staggering. Full year adjusted EBITDA jumped to $6.1 million.
Yeah.
Just a year earlier, that number was only $838,000.
Yes.
Going from under $1 million to over $6 million in adjusted EBITDA shows a complete fundamental change. They're operating a different business now, period.
That newfound cash flow must have had a major impact on their balance sheet. How are they deploying that profit?
Well, it allowed them to deleverage, and aggressively. They cut their net debt by $4.6 million year over year. But what's really interesting is that they used this improved financial health to go back and negotiate better terms on their credit facility.
So it's not just about paying down debt, it's about lowering their cost of capital.
Exactly. They managed to reduce the minimum balance they had to keep, they lowered their actual interest rates, and they even eased some of the reporting requirements. The CFO put a number on it. They expect at least $250,000 in interest savings next year alone from this.
For a company with $2.6 million in quarterly EBITDA, $250,000 in savings is very material. What's the plan for capital allocation now? Are they looking at M&A, or is the focus still inward?
They're staying disciplined. Management said the number one priority is still reducing net debt to the lowest possible point. They're talking about acquisitions, buybacks, dividends with the board, but for right now, it is all about fortifying that balance sheet.
That discipline is what enabled the second, and you could argue more important, part of this story, the shift in what they actually sell. Let's pivot to that. The core message was moving from being a downstream component supplier to a technology solutions provider.
And this is the backbone of that 37% gross margin. This shift means they're selling higher value, more advanced products, integrated systems that solve really specific, complex customer problems instead of just, shipping a commodity cable.
And you can see the proof in the revenue mix. They are moving away from that heavy reliance on the super cyclical telecom sector.
Yeah, historically, telecom was up to 70% of their sales. Now it's down around 50%. The other half is where all the dynamic growth is coming from in these new higher margin segments.
So where's that high margin growth actually coming from? Which specific areas are driving this?
They highlighted three key segments. First is transportation. RFIL supported more than 130 projects in infrastructure markets this past year. We're talking mission-critical connectivity for things like transit systems, smart roads, rail, places where reliability is everything.
And that commands a higher margin.
A much higher margin.
Yeah.
And the second area which we've been tracking is aerospace and defense.
Right.
That continues to be a really strong performer. They had that extra $2 million aerospace order earlier in the year. And these aren't just one-off sales. These are custom, highly engineered systems that have to meet military specs. That complexity raises the barrier to entry, and it raises the price.
And the third one, stadiums and venues. It sounds exciting, but maybe a bit speculative with talk of the LA Olympics and the World Cup.
Well, the activity there is definitely establishing credibility. We should be clear, these aren't signed multi-year contracts yet.
Yeah.
But the work they're doing now, installing the really sophisticated 5G and high-density connectivity infrastructure, it positions them perfectly for those big long-term wins.
Laying the groundwork.
Exactly. So when those massive construction budgets get finalized, RFIL is already the proven certified provider.
Let's talk about a potentially massive new driver. I thought the early stage collaboration with that major manufacturer of electronic cabinets was fascinating.
This is a perfect example of the whole shift in action. They're working on thermal cooling systems for edge data centers. I mean, think about the problem. Edge data centers are small, they're crammed, and they generate a ton of heat.
And reliability is everything.
It's critical. So RFIL is stepping in not as a parts vendor, but as an engineering partner to solve these performance and reliability pain points with integrated thermal solutions. If they can scale that, it opens up a huge market for them.
Okay, looking forward, what did management guide for fiscal year 2026? What are the risks we need to watch?
So qualitatively, the outlook is positive. They said they anticipate another year of sales growth, but they were very careful to manage expectations of the first quarter.
Ah, the dreaded seasonal slowdown.
Yep. They expect Q1, which is November through January, to be the lowest quarter of the year because of seasonality and the holidays. They think it'll accelerate after that, just like it did in FY25.
Which raises the key question. Can they keep those amazing 37% margins when the top line takes a temporary dip?
That is the durability test right there. We also saw some softness in the backlog since the quarter ended. It stood at $15.5 million at the end of Q4, but it had dropped to $12.4 million by the time of the call.
What's the story there?
Management said they expect the backlog to bottom out in Q1 and then start climbing again as new calendar year budgets get finalized and those bigger projects kick in. They see it as a timing issue, not a demand issue.
And on macro risks, they weren't painting a perfect picture, were they?
No, not at all. While their long-term demand is tied to, essential infrastructure, they acknowledge there's still a share of uncertainties out there. They're still seeing cost pressures from things like labor and logistics.
So now let's go back to that market reaction. The 22.6% price jump is just pure validation.
It's the market screaming, "We believe the new model works." What's so interesting here is the low visibility. Formal sell-side coverage is still so sparse. We're talking maybe one analyst with a $9.25 target.
So the big money hasn't really caught on yet.
It suggests the broader market hasn't fully grasped the potential of this new higher margin model. That huge stock move is driven purely by the evidence, not by a chorus of analysts upgrading the stock.
That low visibility creates opportunity, which brings us to my favorite part of the deep dive. Let's put on the analyst hat. We're on an investment committee. We have this data. What's the play?
Okay, so the trade idea is a buy the dip on seasonality play. It's all based on this temporary mismatch between their proven excellence and their short-term guidance.
Lay out the full thesis for us.
The thesis is simple. RFIL just proved they can hit 37% gross margins and 11.5% EBITDA margins. The market instantly priced that in. But management also told us Q1 will be seasonally low. That slowdown is probably going to spook some of the investors who just piled in on that 22% spike.
So you're anticipating a temporary pullback or some volatility when the Q1 numbers actually come out.
Exactly. The strategy is to go long buy shares near the end of Q1, right around that seasonal low point. You're betting that the company will prove the durability of that new profitability model once Q2 and the rest of the year kick in.
When those defense and transportation projects really start to accelerate?
That's the idea. We're basically betting that management's discipline and the new product mix are going to overpower that seasonal dip. You buy the dip, driven by the cautious guidance. You sell the rally, driven by the confirmed long-term model.
Fantastic. Now, zooming back out, what is the single biggest takeaway from this deep dive into RF Industries Q4?
The transformation is real. It's complete. RF Industries delivered a quarter that fundamentally validated their multi-year pivot from being a commodity seller to a solutions provider. The key metrics, 37% gross margin, 11.5% adjusted EBITDA. They've set a completely new and much higher bar for the company.
The success is undeniable, but the challenge now shifts from transformation to just maintenance and acceleration.
And that's the final provocative question for you, the listener, to think about. Management delivered a 37% gross margin in Q4, driven by a perfect mix and high volume. But Q1 is seasonally low. Can they hold that new level of profitability? Or was Q4 an optimized peak? The answer will really be defined by how fast those new high-margin verticals, aerospace, defense, and that early-stage thermal cooling work can ramp up in 2026 to finally override the old telecom volatility. If those new segments accelerate, this growth story is really just beginning.